Imagine you are importing goods from another country. How do customs officials determine the amount of duty and tax you owe? It is a crucial question that directly impacts your costs and compliance in global trade. For imports, transaction value is the primary method used to calculate the value of goods for customs purposes. This value forms the basis upon which import duties, taxes, and other charges are assessed, making its accurate determination essential for international trade. The core principle behind transaction value is rooted in the World Trade Organization Customs Valuation Agreement. This international standard establishes that the transaction value is the price actually paid or payable for the goods when sold for export to the country of importation. However, it is not just the invoice price. It also includes certain additions to that price. These additions can cover things like commissions, packing costs, royalties, license fees, and the value of certain goods or services supplied by the buyer, often called assists, that are used in the production of the imported goods. It is a comprehensive approach to ensure a fair and consistent valuation. To practically apply this, importers must meticulously gather all relevant documentation. Start with the commercial invoice, which states the price paid or payable. Then, systematically identify any additional costs that need to be added. This includes understanding your Incoterms. For instance, if the freight cost to the port of importation is part of the transaction value. Remember to exclude costs incurred after importation, such as transport within the importing country or any construction, erection, assembly, or maintenance services undertaken after import. Clear record keeping and understanding specific regulations are your best allies here. It is also important to know that if the transaction value cannot be determined for specific reasons, such as a lack of a clear sale or unusual conditions, customs authorities follow a hierarchy of alternative valuation methods. These include the value of identical goods, similar goods, deductive value, computed value, and finally, a fallback method. Understanding this hierarchy ensures that even in complex scenarios, a consistent valuation can be reached, which is vital for fair trade and preventing undervaluation or overvaluation that could lead to penalties. Accurately calculating transaction value is not merely about fulfilling a regulatory requirement. It is about ensuring predictability in your international supply chain, avoiding customs delays, and mitigating the risk of penalties. By mastering this fundamental concept, you establish a solid foundation for compliant and efficient global trade operations, ultimately contributing to your business's success and your standing with customs authorities.